Coincidence.
This is the
Good morning, Mina. Good morning. Can you hear me? Mina? Hello? And then we
Hello, la nkutwa ka mo. Buang ka mo luna ke lutlwe. Ha ke lutlwe. Yes, ke a lutlwa. Sharp.
Hi, Era. While we're waiting for Era to connect, let me play a video.
Can you hear me?
Hi, now we can.
Can you hear me now? Can you hear me now? Fantastic. Good afternoon, everybody. It's Era Gunning here from ENS. I am unfortunately going to keep my video off because I seem to be having technical issues with my laptop today. But I'm delighted to be speaking to you today about the Protection of Personal Information Act. I still call the Act Poppy. These days, people call it Popey, Papaya, and everything in between. Sometimes the Popey Act, it's all the same thing. It is our legislation that deals with the protection of that all healthcare practitioners should know about the legislation. We are going to look at how POPIA applies to you, the role players. We are going to look at the information officer and the deputy information officer. Importantly, when can we process personal information, direct marketing, trans-border transfers, including where we use a cloud to store data. We're briefly going to discuss prior authorization, security compromises, and non-compliance. And we're going to end off with what are the must-haves in terms of the Act. Now, POPI has been in the making since before this timeline started. It started in about 2009 as a bill. It became an Act in 2013, but it only became fully effective in 2021. So where we stand now, the Act applies completely, and anybody who processes personal information as a responsible party in South Africa must be compliant with POPI since 1 July 2021. So POPI applies to the fact that we're processing personal information. It doesn't matter where we are based. If you process personal information in South Africa, you trigger POPI. It doesn't matter who your data subjects are, namely the persons who information you are processing, such as patients, or juristic persons, such as a pharmacy or a hospital and the like, would all fall under the activity of processing of personal information in South Africa. So for POPI to apply, we need to have information processing. What is processing? Processing is absolutely anything with a verb. Anything that you do with personal information, if you collect it, if you store it, if you retrieve it, even if you delete it, it would be seen as the processing of information. The next question for consideration is the information we are processing, is it in fact personal information? When are we dealing with personal information? Personal information is anything that relates to an identifiable human being who must be alive for it to be personal information, or an existing juristic person such as a company. So anything from gender, pregnancy, marital status, education, a medical history, an identifying number, all of this would be personal information. But we get three types of personal information in terms of POPI. We get the ordinary personal information, which I have left in black. So that includes pretty sensitive things such as my contact details, my name, my views, my financial or criminal history. But the stuff that I have highlighted in red is called special personal information. Special personal information is treated very specially in terms of POPI. Now, in a nutshell, generally, if you are dealing with ordinary personal information, you don't need a person's consent to process that personal information. You can generally do it if you have, for example, if it's in your legitimate interest to do so, or there's a legal obligation to do so, or you're doing it for purposes of a contract. But the minute you hit the red flag stuff, the special personal information, like race, ethnic information, health, which of course very important to the audience today, medical history, biometric information, then as a general rule, it is very difficult to process such information without consent. Now, in a POPI world, consent must be voluntary, it must be specific, it must be informed, and it must be an expression of will. So it can't be unless you object, we're going to assume it is fine. It must be something like, by joining the Zoom call, you agree that we can process your information by, for example, recording it. So again, as far as special personal information is concerned, please look out for the health information, information about sex life, biometric information, and also information about a person's alleged criminal behavior. And this would typically be if you had to conduct sanction screening, you may pick that up. Background checks may pick something like that up. But if you pick up that somebody has got a criminal record, that is ordinary information. It's this alleged criminal behavior that must be treated carefully, and generally you have to have consent. So I spoke about ordinary personal information. I spoke about special personal information. And then you get special, or you get information on steroids. And that is your information of children, a natural person under the age of 18. Do not touch a child's information unless you've got consent from a competent person, which would be that person's guardian or parent. There are some exceptions. For example, if you're giving effect to a right of a child, and there you can arguably in the medical space rely on the right to health, but it's far safer if you do have consent to process that information. Important touch points where we pick up special personal information could be where you take photos or videos or CCTV camera footage, even WhatsApp groups, that profile pic that you may see. A photo is probably biometric information because a photo uses some sort of technique to help you identify a person. So be very careful when you use photos. Make sure you have a consent. If you've got a CCTV camera up, have a big sign up that says, by entering this practice, you agree that we can use CCTV cameras, and you tell them why you use CCTV cameras. Check where your personal information touch points are. Where do you collect information? Presumably, patients fill in a form when they come to you initially. You might update that form on a regular basis. You might have an app where customers do this online. You also collect information of your employees. Where do you collect information about suppliers, for example, reps and the like? So check where you are collecting information, and check what type of information is it. Is it ordinary, special, or information of children? And of course, when we're dealing with health information or biometric information, note that this is sensitive information. It's categorized as special personal information. Our next topic for consideration is, who are the role players in terms of POPI? I have already mentioned the data subject. The data subject is that person to whom personal information relates. Could be a supplier, could be a rep, could be an employee, could be a patient, could be a hospital. So it's any person, human being or otherwise, who's alive or existing, whose personal information you are using. The responsible party will be the healthcare practitioner. The responsible party is the entity who decides to collect personal information and the reasons for collecting information. But very often, the responsible party can't do everything itself or himself or herself. And for that reason, it may appoint an agent to do something on your behalf. For example, you may use an app to schedule medical appointments. You may use an app to collect patient data. You may use some software. Wherever you use another company or another person to do some processing on your behalf because you don't have the capacity or you don't have the expertise, but you dictate to them what to collect, that person is known as an operator in terms of POPI. An operator is in a fantastic position. It only has 3 obligations. Don't do anything behind the responsible party's back. Notify the responsible party if there is a data breach, and enter into an agreement with a responsible party. So, and those duties are arguably on the responsible party itself anyway. So an operator is the responsible party's arms and legs. And if the operator were to mess up, it would be as if the responsible party has messed up. So it's your arms and legs, you are liable for their wrongdoing. Most importantly, if a data breach had to occur while, say, the patient data is being held by the operator, it would be the doctor's responsibility. So very important, you want to do some due diligence on your operators. This is like handing your child to a babysitter. You want to know what expertise does the person have? Have they been found guilty of data breaches before? What security measures do they have in place? And in terms of Poppy, you have to enter into an operator agreement with them where you contractually impose security measures on them. Then we get our information regulator, headed by Pansy Tlakula. And this is probably the biggest thing that Poppy brought about, the fact that there's a watchdog where any disgruntled person, and it doesn't have to be a person who suffered harm, any disgruntled person can go to lodge their grievances. And this is a free process. So that means that a data subject does not have to go to court to enforce their rights. They can, but they don't have to. They can go to the regulator. Then every private or public body in South Africa has to appoint an information officer. Private bodies may appoint deputy information officers, and that information officer must also be registered with our information regulator. Basically, the highest person in a company, the CEO or the equivalent, would by default be the information officer. If you're a sole practitioner, you will be your own information officer. You can appoint a deputy information officer to help you with this task, and the CEO could also, or the sole practitioner, could also authorize another information officer to fulfill the function. But be aware that our regulator is of the view that delegation is not allowed or outsourcing is not allowed, even though in practice it does often occur. What are our duties of our information officer? To encourage compliance with Poppy, to deal with requests from the regulator, to work with a regulator if they were to do an inspection, and to ensure otherwise that the institution is compliant with Poppy. You must develop a compliance framework, which is not defined, but this is a document setting out how you are going to roll out Poppy compliance in your environment. And very importantly, you have to do personal information impact assessments, which are Poppy audits. A Poppy audit checks what information are you collecting, why are you collecting it, who do you share it with, is it special personal information, is it ordinary information, and so on. And that helps you roll out Poppy compliance. You also have to develop internal measures to make sure that you have systems in place to deal with data subject access requests. And this is when a data subject comes to you and says, what personal information do you have about me? Give me a copy of the information that you have about me. You have to do internal awareness sessions, and you may make a copy of a PIA manual available to third parties, but you must make sure that you have a PIA, a Promotion of Access to Information Act manual on your website. And by the end of this month, you are supposed to file a PIA report with the regulator. So PIA, the Promotion of Access to Information Act, is the sister act to Poppy. And as I've mentioned, you have to make sure that you've got a manual on your website that deals with Section 51 of PIA and also deals with the purpose you are processing personal information for and the like. And you also have to have a PIA manual available at your office. There's some scope for personal liability on our information officer, but you have to do pretty silly things to land up being personally liable. For example, if the regulator issued an enforcement notice, which is basically like an interdict, like a naughty notice, and you tell the institution or the responsible party not to comply with that, or if you're a sole practitioner, you decide not to comply with that, that is an offense, and you can land up getting a fine or go to a nice South African jail for 3 years. Also, if you were to obstruct or to bribe the regulator, that can land you in the hot seat, and that's an offense. Or if you don't have a PIA manual. So please make sure if you don't have a PIA manual, you get one ASAP. Please note that the information regulator is of the view that if you authorize somebody else to become your information officer, you still remain liable for any real wrongdoing. If you are a big organization, you might want to consider having an information officer and deputy information officers that we normally refer to as data champions to help you roll out POPI compliance. Now, when can you process personal information? Just because POPI applies, and POPI would apply to everybody online today, doesn't mean that you are prohibited from processing personal information. All it means is that when you process personal information, you need to do it in compliance with POPI. And the heart of POPI sits in chapter 3 of POPI, and that is the processing conditions. We get 8 conditions that we have to comply with, and you have to comply with all 8. So you can't decide which 3 you're going to comply with. You have to comply with all 8 at all times. The first one is accountability. Accountability simply says, comply with POPI and be able to show you comply with POPI. It's mandatory to have a POPI policy. It's mandatory to have an information officer. It's mandatory to have a compliance framework. It's mandatory to have a privacy statement and so on. And by having those must-haves, which our last slide today deals with, is how you demonstrate accountability. The next 3 processing conditions go hand in hand. Don't touch personal information unless you know why you are collecting it. Simply put, you need to have a purpose before you process personal information. So make sure you document the reason why you're asking for personal information. I myself get very annoyed when I go to a doctor or I go anywhere else, I open a bank account and they give me a whole list of questions and they're asking me things that are completely irrelevant. Make sure that every single question you, for example, ask a patient, every single question that you ask of your suppliers, every question you ask of your employees, make sure you've got a purpose for wanting that information. If you're asking for stuff you don't need, you are breaching POPI. So make sure you've got a purpose and then only collect as little information as you need to fulfill the purpose. Make sure that your purpose is lawful. Now, when we're dealing with ordinary personal information, your purpose would be lawful if there's a law that says you must, if you've got consent, or if you've got another legitimate reason for doing so. So, for example, a legitimate interest reason could simply be wanting to treat a patient. So make sure that you check that your information, that you've got a proper reason which is lawful for collecting information. And of course, if it is special personal information or information of children, it is highly advisable to get consent. So now you've got a purpose, you collect just the information that you need, you know your purpose is lawful. The next thing is that you are going to store the information. POPI says only keep information for as long as you are authorized to have that information. When are you authorized? You're authorized again if you've got consent, or there's a law that says you must keep the information, or you've got some other lawful business reason to have the information. And the last point here is anything that you do with information after you have collected it must be compatible with the reason for collection. You cannot surprise the data subject with how you use the information. You cannot go and sell the information to reps and the like. So your reasons for collecting information, anything that you do with the information afterwards, must be something that your data subject would have expected you to do with their information. So don't collect information of a patient to treat them and then you start sending them direct marketing, for example, unless you make it clear to them up front that you will be sending them marketing material. Information quality. You need to take reasonable steps to make sure that all the information that you have in your possession is complete and accurate, not misleading, and updated when necessary. So yeah, it's a good idea to tell your patients on a regular basis, just check that the information that we have on file is still correct. Openness. Openness says we need to tell the data subject certain things. We need to tell them who we are. We must tell them what information we collect, why we collect the information, if there's a law that says we must collect the information, whether their supply of information is voluntary or mandatory, and what the consequences would be if they don't give us the information. We also have to tell them if we will be sharing the information with third parties and if we will be sending the information overseas. Lastly, we have to inform them about their rights, including the right to go to the information regulator if they want to fight with us. And you give effect to these rights by having an internal and an external privacy statement. Your internal privacy statement is used for your employees, and your external privacy statement would be used for third parties such as patients and suppliers. Security safeguards. You need to implement reasonable technical and organizational measures to make sure that all the personal information that you have in your possession is secure. You have to identify risks to personal information, and then you have to implement measures to make sure that you address the risks. Next, data subject participation. That goes to the rights of our data subjects. The data subjects can ask us free of charge what information do they have about us. And against a prescribed fee, they can ask us for copies of their personal information. So as far as security safeguards are concerned, I would like to tell you about a case where that involves a health issue. So what had happened here is a HIV clinic in London, in terms of similar laws, wished to send their patients information about a new treatment that was on the market. And instead of BCCing, blind copying 780 patients, they CC'd 780 patients. So everybody, and about 700 of those patients were directly identifiable from their email addresses. And of course, everybody could see who else has got HIV. And that was seen to be a security compromise. And the company was fined the equivalent of almost 3 million rand for using CC instead of BCC. So if you're in a situation where you are, for example, emailing patients, make sure that you BCC, you don't CC. Direct marketing. So what is direct marketing? Direct marketing means we approach a data subject, and we do this either in person or we do it by mail or electronic communication. And we do this for the direct or indirect purpose of trying to sell our stuff or asking for a donation. Now, electronic communication, when we do our direct marketing by electronic communication, it is far more regulated than if we had to do it by telemarketing. So basically, if you are going to process any personal information with the aim of sending electronic communication direct marketing to a person, you are prohibited in POPI from doing so unless the person has given their consent or is one of your existing customers. So in a nutshell, POPI draws a distinction between our electronic direct marketing, which is our SMS, our email, our voice messages and the like, and direct marketing by other means, which is our telemarketers, mail, in-person marketing by reps, and so on. Basically, if you are dealing with other types of direct marketing like telemarketing, it can carry on provided the data subject is given an opt-out and you comply with the processing conditions, those 8 conditions that we went through. When you do direct marketing by electronic means, you need consent or the person needs to be an existing customer, like an existing patient. Consent, you can only ask for consent once, and it must be from a person who hasn't opted out before. You can only contact a person once to ask for this consent, and importantly, consent must be in a prescribed manner and form that I will show you now. A customer in a POPI world is a person whose contact details you have obtained in the context of a sale, and then you can only sell your own similar products or services to that person. You can't sell a hospital services or the pharmacy services. It must be your own services. And each time you send direct marketing, you must give the person an opt-out, an easy, free opt-out. Now, we've got something bizarre in terms of our POPI regulations. And they say if you are going to ask somebody for a consent to conduct direct marketing, it must be in a form similar to Form 4. And I'll show you a copy of Form 4. It's a hideous form. Nobody is ever going to complete this to get direct marketing. It must be addressed to a data subject. It must say from, have a fax number, an email address, full name of a human being signing the form on behalf of the responsible party, and then full names of the data subject consenting, and then you have to specify the goods and services and the method of communication. So this is rather bizarre. We have included, and the slides will be shared with you, we've included suggested wording that could be used to get consent, which we think is reasonably similar to Form 4. Very important, this needs to be signed. It's an essential element that this needs to be signed. An electronic signature will suffice. So an electronic signature could, for example, be a click or tick, provided the person signing knows it is a signature. Please note that if you look at the Consumer Protection Act and POPI together, opt-outs must be given in every single marketing communication, and also when you sign up, for example, a new patient, if you're going to send them direct marketing, when you collect the information, you must give them an option to say no to this. And then, of course, in every single direct marketing communication as well. Trans-border transfers of information. You are prohibited from sending information overseas, including for cloud storage purposes or to a hospital overseas or whatever, unless you put at least one safeguard in place. One such safeguard is you sending the data to a country with adequate data protection laws, or you have entered into a contract with the recipient saying that they will treat the data as if they are subject to POPI. But the one that's easiest to rely on is just simply to get the data subject's consent. If you've got the data subject's consent, you can send the information overseas. Which countries have adequate data protection laws? We think the countries that are adequate versus the EU, and there are only a handful of them. So it is advisable to get consent if you, for example, use a cloud hosted overseas. Prior authorization, in limited instances, you have to get permission from our information regulator on a once-off basis if you wanted to process or do certain processing activities. Of importance to you is if you were to transfer special personal information or information of children to a recipient who's not subject to a binding agreement or an adequate data protection law. So if you, for example, had to send health information overseas and you don't have an agreement with the recipient and the recipient is not in an adequate country, you would have to ask the regulator's permission. Even if the person has consented, that is not good enough. Next, POPI has got a very far-reaching provision, namely Section 22, that says where there are reasonable grounds to believe that personal information of a data subject, so not your own information, somebody else's information, has been accessed or acquired by an unauthorized person, then you need to tell the data subjects and the regulator. You need to tell them about it in a prescribed manner and form, and you need to do it ASAP. Now, in terms of other laws across the world, you only have to tell the data subject and the regulator if there is a substantial likelihood that it can cause harm to individuals. We don't have that threshold. So if you had to CC people on an email where they should have been BCC'd, if if you were hacked, if an employee steals data, all of this would be seen as an unauthorized access, which must be reported to the information regulator and the data subject. So be careful when you let your employees use their own devices at work. Give them certain rules as far as what they are allowed to do with their own devices. Consider shredding documents, but Barclays UK left some documents outside to be shredded. They were stolen by data thieves and they were fined £20 million for doing this. Be careful of BCC versus CC and educate your staff. Get rid of old employee records when you are no longer obliged to have them. And don't keep records for just in case. Only keep records if you need those records. What happens when we don't comply with POPI? Any person can go to the information regulator. The regulator can then try and secure a settlement. It can initiate an investigation. If it finds a breach, it can issue a naughty notice. And if you don't comply with this naughty notice, we are dealing with an offense. Offenses in terms of POPI can lead to up to 10 years in jail or 10 million rand fine or both. The data subject or the regulator can also sue you in a court of law, and damages that they can sue you for includes patrimonial and non-patrimonial loss. Patrimonial is, of course, monetary loss. Non-patrimonial loss is, I feel sad, I was defamed. And we had a case even before POPI where a doctor on a golf course told another person that one of his patients had AIDS. And the patient happened to know the third party who told him about it and took the doctor to court in terms of our common law of privacy. And certainly you would now have a much better case if you breach confidentiality and cause non-patrimonial loss, if you take it on in terms of POPI. Aggravated damages, if you've been very bad, interest and legal fees could also be claimed for. Lastly, I would like to share a POPI checklist with you. And this is what you should have in place since 2021 already. If you don't have this in place, you are in breach of POPI. You have to have an information officer and register the person. You have to have a privacy statement and make mandatory disclosures to your data subjects. You have to implement a POPI compliance framework. You have to have a POPI policy. You have to do a POPI audit and gap analysis to see whether you are non-compliant. You have to have a PIA manual, make it available at head office and on your website. You have to have a data subject access request policy. You have to do internal awareness and training. And you also have to have those agreements with your agents or your operators. And at that point, that is just about the last thing I wanted to tell you. Just also to mention that ENS has put together what we call a POPI toolkit, and a POPI toolkit comprises of all these mandatory things that you have to have in place, which is very easy to customize and to fast track POPI compliance. And at this point, I hand over for questions.
So good afternoon, everyone. Thank you for listening to Era. I think she's been very informative in terms of the POPI Act. Please feel free to either type your question into the chat box or alternatively ask to be unmuted if you want to ask one in person. We will be asking one question to each, to all those registered delegates. The first correct answer will receive a free book from Shivdev Training Academy. I will type my telephone number into the chat box. You can then just WhatsApp me your details in terms of where the book needs to be delivered. We leave the floor open to all our delegates.
You are also welcome to share my email address and my contact details should somebody wish to ask a question after the session.
Thanks, Era. I will definitely do that.
Well, I suppose if there are no questions, would you like to end the session, Mina?
Thank you, Era. I'm sorry, my introduction was actually not muted. So I just wanted to say thank you very much for attending this webinar and giving us your expertise. Era is from ENS Africa, one of the largest law firms in South Africa, and we're very, very happy to have you today. Thank you very much. I will hand over to the next speaker. Yes, thank you.
So yes, I see somebody in the chat has asked for the slides, and we will share it with you with absolute pleasure. I'll send it to you after the session. So from my side, thank you very much for attending. If you do have questions, please feel free to contact me. Goodbye.
Good afternoon, Prof. Would you like to share your screen?
Yes, we're going to do that now. Can you see my screen?
Yes, we can. Yes, we can see your screen.
Yes, you can.
Thank you.
Okay,
Yes,
may
thank
I
you.
start?
Welcome. Yes, you may start. Thank you very much.
Thank you. Thank you, Mina. Thank you very much, Mina, for giving me this opportunity to talk on Let's Talk Your Wealth and Your Tax. It is certainly something that affects everybody in their lives, and in particular, people in the medical profession. They, in fact, see patients, but they spend most of the time as clinicians, and the money just comes thereafter. But what you do with your money and how you pay your tax is so critical. So what I'm going to be talking about is the aspect of tax, as well as how do you accumulate wealth as a medical professional. Just to introduce myself, I'm the CEO of Garach Corporation. It is a financial and fiduciary consulting practice comprising of chartered accountants, lawyers, tax consultants, and certified financial planners. I myself am a chartered accountant and a certified financial planner. I held professorial positions at various universities. I was South Africa's Financial Planner of the Year in 2004, for almost 20 years now. I've served on government and commercial boards, and I am a financial coach to high net worth families. So the content of my presentation, I will be covering taxing times are here, unfortunately, and you see this is becoming so prevalent now that you see the Commissioner of SARS almost on a daily basis, literally pronouncing new things that SARS are doing. And therefore, I think you have to be acutely aware about your taxes. So having said that, nothing stops you from planning your own tax, planning your own affairs to avoid any kind of tax. And that is what one would do, and that is what I'm going to show you now. What is also important is that as a professional, you amass wealth, but how you structure that wealth is important, and how trust can play a role in structuring that wealth. We're also going to talk about wills and estates, the administration of estates, and how that will affect you and how you need to draw up your will. We'll talk about private wealth management. In other words, how do you manage your private wealth? And something that is fairly new to us when the Financial Action Task Force have now grey-listed South Africa in terms of all this money laundering and terrorist activity. We now have to follow some new provisions, and I'll let you into that. Also, what is important is, as a medical practitioner, how do you manage your medical practice? That is also important.
Excuse me, I'm sorry to trouble you again. There's been a bit of a mix-up. My wife brought me here at 9 o'clock and to see the eye specialist, and we went away about an hour ago, didn't we? And then we did a bit of shopping and went home. And now, do you know, I think he's given me the wrong glasses.
Oh, what makes you think that?
Well, this isn't my wife, you see.
Now, is this medical negligence? I'd just like to ask you that question. Do you consider that as medical negligence? I think that's part of your ethical portion of this particular seminar. Taxing times are here, undoubtedly, as you can see, that if you've been enjoying all this wealth about living in fancy homes, as well as having yachts and having fancy cars, I certainly think that you have to be very careful as you thread forward. So there is no doubt that if you are in a medical practice, why do you have to prepare annual financial statements? Firstly, you'll probably do it for the bank, because remember, you probably have an overdraft, and the bank is an interested stakeholder in your practice, and it will require, just to ensure that they are going to get paid sometime in the future. So banks request you to produce financial statements. What is also important is another role player in your practice is the South African Revenue Service. Remember, they are the silent partner in your practice. They always want to know exactly how much money you make, because silently, if you're on your maximum tax bracket, you probably have to share half of your profit with them. So therefore, they're very keen on knowing what you're doing in your practice. So you have to prepare financial statements to keep them happy. So having said that, I think as we go forward, and then I did indicate that the SARS commissioner is now getting very, or SARS itself is getting very strict about how they are viewing high net worth people, including professional people. And therefore, on that basis, you have to engage an accountant who has got strong tax expertise. Now, why do I say that? He needs to be conversant with new tax laws, and the underpayment of taxes is so important to you as the practitioner. So if your taxable income for the year exceeds 1 million rand, now what do I mean by that? It means the fees that you earn less all the expenses in your practice. In other words, the salaries that you pay, the rental and so on. If that amount, together with interest that you earn and perhaps investment income that you have, if that exceeds 1 million rand, then you have to pay your taxes within the same tax year. So by the end of February 28, by the end of the tax year, which is the 28th of February of any particular tax year, you're meant to have paid your taxes. Now, you normally do it through provisional taxes. You normally have first provisional, which is due in August, and the second one is due at the end of February. You should have paid your taxes. Now, if for any reason you didn't pay the full tax, and let's face it, it's very difficult for you to work out what your exact tax liability is on the last day of the tax year. But for any reason, if you didn't pay the full tax that was due, you will find that SARS will levy an understatement penalty. The understatement penalty happens to be 20% of what you underpaid. So typically, if your income was 1.5 million and you actually paid only on 1 million rand, so it means that you've underpaid by 500,000 rand. So they impose a penalty of 20% of the 500,000 rand. Immediately, you could get slapped with a 100,000 rand penalty. There is a bit of a leverage. They talk about a 20% margin that they would give you a bit of a leverage, but that's for another time that you need to look at. Plus, if you didn't pay that tax timeously on the 28th of February, they will, other than the penalty, they will levy a further interest on the outstanding balance because they believe that you had to pay fiscus timeously. If you didn't pay the fiscus timeously, you didn't pay the government timeously, they will add interest on that. Also, we have often clients who tell us that, you know what, I know I underpaid it. Can't you just hide it, just increase my expenses, show less income? But remember, that is what we call omitted income. And if you omitted, if they catch you as SARS, that you've omitted your income, they can even further penalize you by a further up to 200%. So we go into more detail a bit later, but that is something that you also have to consider. So having said all of that, I think it's important for you to find yourself a good tax accountant. That's so important. Now, it's not all about peanuts here. It's writing to the receiver of revenue. I'm writing to you to cancel my subscription. Please remove my name from your mailing list. It's not all about that. Today, SARS will catch you. How do they catch you? So SARS have got an independent way of establishing what you own and what income you have. And there is a tie-up directly with the following institutions, the banks. So they have a direct link with the banks to get information about you. We spoke about Poppy now, but this is going beyond Poppy. The deeds office, in other words, what properties are registered in your name? Perhaps properties may be registered in a closed corporation in which you're a member, or in a company in which you're a director. CIPC records, again, that's the company records that is normally kept separately. Car registrations, also the cars that are registered on your name with your ID number on it. Insurance companies in where you hold investments and life policies and so on. And this list can continue. Now, as a medical doctor, there was a move afoot to try and get information from the medical aids to be sent directly to the SARS computer. And what they were then meant to do is compare the total of all the medical earnings, medical aid payments that were made by the medical aid against the fee income that you are reflecting. Now, if they get there, then imagine through the computer, if there's a 5% variance, automatically it should throw out for audit. Now, if they get to that point, then I think certainly doctors have to be very wary about what they put into their financial statements that will go through to SARS. I certainly think that it is taxing times for rich people. tax evaders have to be very careful. In my view, if your income doesn't match your lifestyle expenses together with the growth of assets in any particular year, they will send you a what we call a lifestyle questionnaire. And when they send the lifestyle questionnaire to you, they will then establish what lifestyle expenses you have, what was your income that you've already declared to them, how your assets have grown over the one tax year, and then effectively do the reconciliation, come back to you with undeclared income. Now, if they do come back to you with undeclared income, then they will levy a penalty in terms of the Tax Administration Act. Now, this particular slide clearly shows you the taxpayer behavior. And what do we mean by that? We mean that the taxpayer behavior, if you look on the left-hand side of the slide, can either be substantial understatement, it could be reasonable care not taken in completing a tax return. In other words, you must know what is in your tax return and not your account. No reasonable grounds for a tax position, gross negligence on your part as a taxpayer, or intentional tax evasion. And then if you go to the top again, and if you go and move to the right, it says over there what would be a standard case, what would be obstructive, or a repeat case. In other words, you're continually doing this on a year-to-year basis, or where there's a voluntary disclosure after SARS comes to you and says to you, you know what, you have a problem, you didn't tell us all the income that you have, or you actually voluntarily go forward before the audit and you say to them, oh, I'm sorry, in the tax year 2022, I didn't tell you, give you my full earnings. I had a second bank account. I was depositing money in that account, and I didn't tell you I have 200,000 Rand. So you can see how this can vary. So as far as the actual penalty is concerned, it's called an understatement penalty, a USP. It can range from 0% to 200%. And you can see the 0% is where there's been a voluntary disclosure before an audit notification, the one that I just indicated to you, or where there's intentional tax evasion. You'll find that in that case, there'll be a penalty of 200%. So you'll pay a penalty of 200% plus the 100% tax. So you are literally stone dead when they come and catch you and there's intentional tax evasion. You didn't tell them about it. Having said all of that, SARS definitely has a heart. I say this because it is possible when you have a SARS debt that it will compromise that particular debt. So why would they want to do that? Well, if I may say that they have a heart, they want to still see you in business because remember, they are your partner and they still want you to continue paying tax going forward. So therefore, they can possibly consider, if you have a 10 million Rand debt, consider compromising that particular debt, provided, again, you have a good tax consultant who can motivate a good cause for you, that you'll continue in your professional practice and that you'll continue to employ 10 or 15 people. They will be quite happy to see that happening. And then provided your motivation is good, they will consider a SARS, what we would call a compromise from their side, and reduce the actual tax liability. And that's forgotten. And going forward, you then continue to work and then share half of your profits. This is Albert Einstein saying the hardest thing in the world is to understand income tax. There's no doubt that tax is a very difficult topic. It's one thing today, tomorrow it's something else, and the next day it could be a third thing. So therefore, to understand tax, it's extremely difficult. It's not like just automatically understanding a patient's problem and trying to work that out and then saying that this is the right course that one needs to take. Having said all of that, I certainly believe that you can do some tax planning. Tax planning means you're trying to avoid using legal means. And if you actually do that, you can compare tax planning or tax avoidance using legal means against tax evasion, which is what I explained to you now, where you deliberately omit your income. And on that basis, you could be slapped with a 20% penalty. So in the case of tax planning, what can you do to avoid tax? I'm not here to show you how to pay no taxes, because that's not the whole purpose of this particular presentation. The whole idea is that we all want to enjoy the fruits of this country, and therefore we must contribute to the government coffers. So what are the different things that I can do to make sure that I can plan my tax affairs so that I pay the least amount of tax. Firstly, we must understand that we have a progressive tax system in South Africa. What do I mean by that? I mean that as you earn more, you pay more in the form of taxes. So any income for the year that you earn less than, let's say, 90,000, because that's where the threshold is, you pay no tax. And from 90 to 200,000, you'll pay 18%. And that progression goes on to about 1.7 million rand. At 1.7 million rand, there's a cutoff which says that you will pay 45% tax. So that's the highest tax bracket. That is what I was referring to, that if your income is sitting at the level of 1.7 million and more, you will pay a flat rate of 45 cents in the rand for every rand that you earn. I have many clients in that tax bracket who actually tell me that, you know what, maybe I should consider stop working. I'd rather go and play golf or do other things rather than work and let SARS be earn half of my income. I certainly think it's a valid statement that is made, but unfortunately, if you have commitments and so on, you have to just continue working. So it is possible to split your income. So typically, if you have husband and wife that let's say in a practice, and let's say if the wife is the medical doctor or the business person, and you find that the husband performs administrative work, it is possible if for example, the wife's salary in my example, or income from the profit, income from the practice rather, happens to be 2 million rand. It is possible to introduce the husband, and for the administrative part that he plays a role, is to split that income rather than the wife in my example getting 2 million rand of income. You bring the wife into the practice and you say that she can she's doing all the administration, attending to the administration of staff, etc., and perhaps give a reasonable or a salary commensurate to the services that she will perform. And let's say if you give her a salary of 500,000 for the year, by splitting that income, you understand that you are reducing your income and therefore she will pay tax from 0 to 500,000, and her tax rate will be a lot lower. So by doing that, yes, certainly you will reduce your taxes. Also, for example, if you have university going children, they perhaps help you in whatever form in your IT systems and so on. You could bring them onto the payroll and effectively give them a salary as well. So they are rendering a service to the practice, and based on that, you put them on the payroll, and you could even give them 100,000 rand and perhaps pay little or no tax on their income, and that will be treated as an expense in your practice. And then you could even pay for the university fees in that way. So there is room for, because of the progressive tax system, is to split the income and therefore pay less tax. Also, you need to consider that if you're a wealthy person, is it better to receive a salary as against investing in assets? And the assets I'm referring to is shares in the stock market, let's say, or for that matter, buying property, immovable property, as against getting a salary. Now, certainly, if you're a wealthy person, if you were to get a salary more than 1.75 million, then that is going to be taxable at 45 cents in the rand. So you're at a distinct disadvantage. On the other hand, if you own, let's say, an immovable property, you get income in two forms. The one income that you get rental, which is subject to the net rental income. In other words, your gross income after your expenses gives you your net rental income, and that net rental income is subject to income tax. However, the bulk of your income comes in the form of a capital gain when you sell your immovable property. Now, when you actually do that, that immovable property profit will be taxed as a capital gain, and the maximum tax rate that it can be taxed at, again, it's a sliding scale, the maximum rate it can be taxed at is 18%. So you can see there's a tax difference, or what we call in tax parlance a tax arbitrage, the difference in the rate. So that is how wealthier people or wealthy people become wealthier, by owning assets and getting capital gains rather than getting a salary and being taxed half of it. Also, you can consider using a corporate entity. So if you're in a medical practice, or if you've got a company, you could incorporate your company, or rather you could incorporate your medical practice. So if you're a solo practitioner, and if your income exceeds, let's say, 1.5 or even a million rand, you should consider incorporating the practice. The reason being, companies and incorporation are taxed at 27%, a flat rate of 27%, as opposed to when you, in an individual's case, he will pay tax at a sliding scale, but going up to 45%. So you can see, again, there is this tax arbitrage, the actual difference between the two. So you would take a salary from the practice, which is more or less equivalent to the 27%, and whatever profit you have left in the practice, you would then let it be taxed within the practice, and that will be taxed at 27%. So immediately you can see that there is a tax saving by you not having to pay the higher rate. You could keep the profit within the company, and the after-tax profit, you could perhaps use that for investing, for doing any kind of investment. So you could invest, for example, in hospitals or in public companies or listed companies or whatever form. So clearly using corporate entities when your income exceeds a certain level or a certain bracket makes perfect sense. Using the solar energy investment, which is fairly new, it replaces the old Section 12J of the Income Tax Act. This is Section 12B of the Income Tax Act. There is no limit on the deduction, so it is possible to reduce your income substantially just by investing in the solar energy investment fund, which is like a separate fund that invests in solar energy. Now, this is mainly due to the fact that Eskom has let us down badly, and based on that, more money that goes into private investments into solar energy, a tax deduction is given. But certainly you can see that all of this tax planning can only be done with the help of a tax consultant. And a tax consultant is a highly specialized professional person. You need that special professional person to assist you through this maze of things, so that you know you're making the right decision, taking your things forward. You could also invest in a retirement fund. So now typically, these are the normal retirement annuities that you get. You could be a pension fund, it could be a provident fund, it could even be a retirement annuity fund. So typically, if you invest 100 Rand in a retirement fund, then what happens is that, and let's say you're on your maximum tax bracket of 45 cents in the rand, then it means that you are paying, of the 100 Rand, you are paying 55 Rand, and SARS is helping you because your tax will get reduced by the 45 Rand. But the advantage is that the full 100 Rand is going as a credit into your retirement fund. So the credit to the retirement fund is 100 Rand, but you've only contributed 55 Rand. So you can see that you're getting an immediate return on your money. You put in 55, but 100 Rand is being credited to your retirement fund. If you don't make this contribution, then you lose the 45 Rand in the form of tax. But I think what is important, and that's where people went wrong in the past, you didn't manage your retirement fund because insurance companies took your money, didn't allow you to manage it. That's a substantially changed now. You can manage your own fund. You need to get a financial planner who will sit with you on a year-to-year basis, look at the returns on the fund, move funds around with minimum costs, and you need to do that. You need to watch the fund performance and actually get into the crest of the wave as the investments grow over a period of time. There's obviously a formula that applies in this case. You can't contribute more than 27.5% of your taxable income up to a maximum of 350,000 Rand a year. So unlike the Section 12B, the solar energy one, where you could make any kind of contribution, this particular one, you are restricted in your contribution. So moving on now to something about asset structuring, drawing up your will and setting up a trust. So you have assets, I think and that's going to grow in value over time. So what are the assets we're talking about? It could be residential property, it could be commercial property, it could be shares on the stock market, it could be unit trust investments. All of those over a period of time will grow in value. So ideally, it should not be in your name for various reasons, which I'm going to go through now. It should be actually ideally held in a trust. And the whole idea is, if you have a trust running for yourself, then I think drawing up your will becomes very pertinent. And you can read that clearly. There's the will of somebody, the last will and testament, I being of unsound mind, hereby bequeath 40% of my estate to the taxman. That can happen to you if you don't plan properly. So what is a planning mechanism that I'm talking about? So if you use a trust because it suits you to use a trust, then certainly from an estate planning point of view, means that you're going to pay the least amount of estate duty. How does that work? So typically, if I see a property, let's say in Sandton or in Umhlanga, or for that matter in Camps Bay, and I acquire this property, and I acquire it in the name of a trust. So when I acquire it in the name of the trust, it becomes an asset of the trust. It's a building for 10 million rand. 10 years later, I die. And then that property has now grown in value substantially over the 10-year period. And let's say it is now worth 40 million rand. Now, because I didn't buy it in a company in which I held the shares or in my personal name, it means I bought it in a trust. Then for estate duty purposes, it is not my asset. It belongs to the trust. Therefore, it's excluded from my estate, and I've saved myself that figure of 40 million. I've saved myself estate duty, which is levied at the highest rate at 25%, as well as capital gains tax, which you saw just now at 18%. I've saved myself 42% literally by putting it into the trust. So it gets excluded as an asset in your estate, and certainly it is a serious advantage. From a tax planning point of view, yes, if you have, for example, let's say in this example, I've got 5 beneficiaries who are all minor children of yours. If I had income of 375,000 Rand, if I was to tax it at your highest tax rate of 45%, I will then pay 170,000 Rand in tax. If I now decide that I set up this trust and I have beneficiaries that are age 1, 2, 3, 4, 5, I have 5 beneficiaries, I split that income of 375 and give each of my children 75,000 Rand. You will see that because I'm below the threshold of 90,000, the tax bill for each of my children is literally null, and I've saved myself every year 170,000. Now, provided the circumstances permit, you can consider this one. Again, I make the point that you need a tax consultant to actually advise you. What are the other benefits of a trust? It certainly protects your assets, and as a medical professional, remember you can get sued for something, and if the assets are in your name, then they can get attached. It could be professional negligence, or it could be any other form. But if the asset is in a trust, where, for example, you, your spouse, and your children are beneficiaries, those assets will not be touched at all by creditors and people who are suing you. Succession planning, yes, certainly, if, for example, you have a couple of children together with your family, it's much better and much easier to put these assets into a trust, and succession planning is then achieved for yourself. If you have minor children, you can't pass assets over to minor children. If something was to happen to you, then therefore the trust does become relevant. Continuity, you have trusts that are many that run for generations. Without mentioning any names, there are trusts that are running for over 100 years. You can continue using that as your family trust. Certainly, there are savings upon your death. If an asset is in a trust, you pay no estate duty, as I pointed out to you now. There's no capital gains tax to pay because death results in an event, and you have to pay capital gains tax on assets that are in your name. There's no transfer duty to pay. There's no executor's fees to pay. So certainly there are huge advantages of setting up trust, provided it suits your personal requirements. SARS have literally cottoned onto trusts, and you read about it every day that they're trying to legislate against trusts. So what they did in 2017, they introduced a new section in the Income Tax Act called Section 7C. And if you have trusts, you have to be aware of the section. What they've done is they've put their brakes on people who are using trusts to avoid paying taxes. Now, those were the 2 taxes I clearly mentioned to you. It was estate duty and income tax. They've now introduced a new section. You need to understand the section, but there are obviously ways to circumvent Section 7C. You just have to rearrange your affairs in a way and make donations and so on. So there's still opportunities. It's all about planning and all about bringing in the tax consultant to play a key role. Moving on from there to wills and estates, I think it's important for you to, if you have assets in your name, to draw up a will. So typically, if you are the person who dies, and if you have a valid will or you don't have a valid will, or you don't have a will at all. So if you have a valid will, and I use the word valid because you have to follow the provisions of the Wills Act, which is pretty rigid, and you have to have certain things in place, so you can't just sit at home and draw up a will and think that it is valid, because lots of wills that reach the master's office, they realize it is invalid, and then it becomes no will at all, although you may have set up instructions. So if you have a valid will, You've given a set of instructions to appoint an executor. You have listed your beneficiaries and what they will inherit. Then it will devolve as per your instructions in your will. But on the other hand, if you don't have a will, then your estate will devolve according to the laws of interstate succession. Now, the laws of interstate succession are very inflexible, very rigid. People may, who you don't want to benefit, may end up benefiting. You may also have a situation where people get appointed as the executors of the estate, where you never dreamt of those people being part of the executors of your estate. But unfortunately, you don't have a valid will, and that's exactly what happens. But therefore, it's very important for you to ensure that you have a valid will, that you update it every year, and that it is personalized to your circumstances. You hate to have a will that you drew up 30 years ago, and effectively when your children were still minors, they have now left the country, they are majors now, and they're probably living in other countries, and now this will surfaces because it was done it was done with somebody who never cared to check with you on a year-to-year basis to get it updated and to make sure it's personalized. Administration of estates, I think this is another very important area that you need to have a look at. And typically, how long does it take to wind up an estate? Does it take months? Does it take years? Does it take decades? Never gets done. But you ask yourself why. So these are reasons for delays in the estate. There is no valid will. So can you imagine you're sitting with either no will or an invalid will? There are missing documents, your IDs, your marriage certificate. When you're trying to establish the person who's helping you to wind up the estate, find the marriage certificate, and the surviving spouse takes 6 months just to get a copy of the certificate. The title deeds are lost. Financial information not up to date. You haven't prepared your financial statements up to date. Your tax returns have not been submitted. You have complicated business interests with no estate planning. You have shortfalls in the estate, and you're unable to cover the liabilities and the expenses. So how do you address all these delays? You must have your documentation in place. Therefore, in our office, we recommend that you give us all the documentation, and we have a checklist that we draw, and we have the documentation electronically filed. And then it's all about planning all these things: the financial information, your business interests, making sure there is sufficient insurance to cover any liabilities, making sure the expenses are met, and that is terribly important. Family wealth grows over a period of time, paying over generations. Paying taxes is a harsh reality. You should consider the following. Are the assets structured in the appropriate entity? Are your tax affairs in order? Do you have a properly managed family trust or more than one trust? Because you could have a family trust, a shared trust, a business trust, a property trust. Do you have properly structured will? Are your beneficiaries properly stated on your insurance and investment policies? You cannot nominate minor beneficiaries as as beneficiaries in insurance policies. The money is then just taken up by the Guardian Fund, and it's very difficult to get money out of the Guardian Fund. Very important. Does the will, the family trust, the insurance policies, and your personal assets tie up? That is a very important exercise that you need to do. Strategic wealth management. Certainly, you being medical doctors know for a fact from a profile point of view, we like to take the dashboard approach. So if you look at the medical checkup that you expect your patients to do for you, what normally happens is that your patients come and see you once a year. You check on the blood pressure, check on the blood sugar, you check the cholesterol, and you do an ECG. And once when you find that all these are normal, you would give a clean bill of health to your patients. I'd like to ask you this question. How often do you do a financial checkup? And how and where do you do that? You need to go to your financial planner. You need to look at your risk cover, both for yourself and your family. You need to look at your wealth creation to your retirement. You need to look at your tax position. You need to look at if you have an inter-vivos trust, have you been using it? Is it updated? You draw up the financial statements. What are the assets? Do you have a properly structured will which has been updated? So typically, you need to ask yourself the question, if you were to die suddenly tomorrow, will your family continue to maintain the same lifestyle that you've been giving them? So typically, we've had many clients where we have not been involved. The financial planning, you find that the person dies suddenly, they are like 45 years old, they get a heart attack and they suddenly drop dead. However, their children are all now, in terms of the fancy lifestyle they've been enjoying, children are all at private schools and so on. The next thing, you drop dead and there isn't sufficient life cover to make sure the capital is used to invest and then give them monthly income. So if they don't get the monthly income, effectively those children have to be removed from private schools and put into state schools and so on. And we've seen this heartache, we've seen these difficulties practically. So that is why we would advise you to do this. I mean, typically, also something happens to you suddenly, and now you're looking for income disability benefit. You should have had PPS in place to make sure that your normal income you were getting out of your practice, you're not at work anymore, you get the PPS benefits that are paid to you, or any other kind of income benefit that you're meant to receive. Therefore, in our practice, we always encourage our clients to do a financial needs analysis on a yearly basis. We then prepare a financial planning report, and the report will then identify the shortfalls and so on, and make sure that on an annual basis, everything is kept up to date. Okay, so this is typically, how do you invest your money? So here you can clearly see on the, there is a slide here that reflects the word security on the left-hand side of the slide. On the right-hand side, you see the word growth in pink. And then you see at the bottom, literally on the x-axis, saying savings, fixed deposit, participation bonds, insurance policy, investments, unit trust, shares, and risk capital. So now, typically, if you're a high net worth person, and let's say you decide to put your money in savings account. So when you put your money in savings account, let's say you get 6% return. But if you're a high net worth person, remember, you're going to pay 45% tax on the interest. So your after-tax rate of return is 3.2%. That's way below inflation. Certainly, you're getting a net return where your growth potential is small on the savings. However, your security is great because you're investing with a bank. Now, if you go to the extreme right-hand side of this particular graph, you'll see that if I invested my money on the JSE in the form of equity shares, the growth potential on that equity shares is great. However, the security, if you take the yellow line, is very small. So where should you invest your money? All in the middle, into unit trusts and maybe insurance policies, etc. No. When you are young, you have time on your side. Therefore, you must concentrate on investing in shares, risk capital, unit trust, all of those kind of investments, and you want that to grow because you have time on your side. You're only 30 years old. You're only going to retire at the age of 60. You put all your money there, and hopefully you'll get an average of 15 to 20% return over a period of 15 to 20 years. And then once when you get to retirement, then all your money can be stuck into savings accounts, because then you have a large lump sum of money and you want good security. It doesn't matter if the tax is high, but at least you know for a fact that from a security point of view, you're protected. And a lot of people don't follow this principle, and they end up having serious issues in their retirement. Offshore investments, it certainly makes sense to look at offshore investments. You want to diversify your risk, because remember, the South African economy makes up less than 1% of the global economy. And the South African economy, with all kinds of issues that they have, both politically and otherwise, South African economy is becoming totally insignificant. Although the South African economy is largely resource-driven, and did you know that South Africa is one of the richest mineral resources in the world? I want to repeat that statement. South Africa is one of the richest mineral resource countries in the world. Look at the rand in 1994. It was 3 rand 50. Look at the rand today. Look at the rand and what it's going to be in 10 years' time. So risk diversification is important. Rand depreciation will continue to depreciate in our view, because the Eskom problems will never get sorted. Geopolitical risk is certainly a problem in this country, and we know the whole African continent has got that problem. So what should you be doing? You should try to invest your money offshore. And there are two ways of doing that. You either invest it with a local financial institution in rands, and they take your money offshore. You have to bring that money back sometime in the future, but it makes sense to do that because you're getting offshore returns in a diversified portfolio. You can also decide to take your money offshore. In other words, change your money from rands to dollars to euro to pounds, and then invest it offshore is another option. But then there are investment limits you need to understand, In an offshore investment, you're governed by 10 million rand annual investment allowance. You're also governed by the discretionary allowance of million rands. What is available? There's lots of innovative investing that is being done, and you can understand that the financial institutions are now going out and looking for these offshore investments on your behalf, because they really believe that one needs to invest offshore. There's some unique capital guaranteed products, and if you speak to your financial advisors or if you come to us, we'll certainly let you into these things. If you're a professional person, it makes perfect sense as a medical doctor for you to invest in the PPS purely on the basis because the PPS is a mutual company and you share in their profits. So there's a 2021 accumulated profits of 31.5 billion rands, which belongs to you as a private shareholder. As we know that South Africa has now been grey listed by the Financial Action Task Force. And what does that mean? Several of our acts have now been changed. The Financial Intelligence Center Act, the Non-Profit Organization Act, Financial Sector Regulation Act, the Trust Property Control Act, the Companies Act, which means that you cannot hide behind these acts and say you are a nominee shareholder. So that has fallen away totally, or a nominee beneficiary of a trust. Your names have to be disclosed to these various institutions that you are attached to. So clearly, as a medical professional, I think you have to bear this in mind. You cannot hide behind entities and pay least amount of tax or not show yourself as a beneficiary and be a nominee. So that clearly affects you, and I think you need to consider that. Management tips for a medical practice. I really believe that you need to learn to manage your practice, use electronic medium in all your work. I know for a fact that I go to see GPs and see specialists. I still see many of them using handwriting notes and so on. I think it doesn't make sense at all. You need to make sure that everything is electronic. You need to confirm your appointments on a daily basis, enhance communication with giving handouts to your patients, use a practice manager for your accounts. And I think what is most important, and this is what causes you a lot of stress, you do well as a clinician, but you don't have a good accountant, a good tax accountant to advise you. And therefore, I would advise you find a good tax accountant. Otherwise, and now listen.
You're just too good to be true. Can't take my eyes off you. You'd be like heaven to touch. I wanna hold you so much. At long last, love has arrived, and I thank God I'm alive. You're just too good to be true. Can't take my eyes off you.
Right, so you can clearly see that somebody is very interested in your business because they are a partner, a silent partner in your business. Therefore, you must make sure, if you want to avoid stress, make sure that you have a good tax accountant to help you. So we are a multidisciplinary firm as Garach Corporation. We have chartered accountants, we have lawyers, we have certified financial planners, we have tax practitioners, we have business rescue practitioners. All of these professionals sit in one team, in one firm, under one roof, so that you get advice, you get the best possible advice from one practice. You're not inconvenienced by running to different people. And what are the service offerings that we have? We advise you on your tax matters, on your accounting, on your business and business advisory, your insurance, your investments, on your wills, your trusts, your deceased estates, and business rescue. We have offices both in Durban and in Johannesburg. Those are our telephone numbers, and that is our email address. We also have a website. You can have a look at our website. So that covers everything that I wanted to tell you. I wanted to thank Mina and Chief Dev for giving me this opportunity to share this information. This is my 45 years of experience in all my fields, both as an academic and a tax practitioner, and having served on the SARS board and being part of government organizations and so on, and being in private practice and being part of the universities. So it's time for questions. I'm quite happy to take questions if you have them.
Thank you, Prof, for that excellent presentation. And we're honored that you found some time to give us this talk and enlighten all the health professionals here today. Roshni, will you come on for Prof?
Yes.
Thank you.
So good afternoon once again, delegates. As we said, as Prof has just said, it's question and answer time. Please feel free to tell us to unmute you if you would like to ask a question in person, or alternatively, type your question in the chat box and Prof will gladly answer it. I'm also going to be sharing Prof Garach's assistant's telephone number with you in the chat box. So please feel free, if you need to send him a question or you need to connect with Prof, you can do so on the email that was on the slide, or alternatively via the telephone number that I'm going to be typing into the chat box. We will be, Mina, are we going to ask the questions, or you're going to ask Prof to ask the questions?
Hi, Prof. Would you be able to ask 2 questions from your presentation for the audience to get 2 book prizes?
Should I ask a question? Do you want me to ask a question?
Yes,
Just
please.
Yes, okay. The question for today is, what are the tax planning mechanisms that you can put in place to avoid paying taxes?
Please feel free to put it on the chat. We can also do a lucky draw, Rosh. Do you want to choose the number from 1 to 25?
Okay, let's do that. I don't see, I'm sure a lot of, oh, here we go. Create income wages even to your children. Prof?
Yeah, I think that's good enough. Yeah, that you can take that as a, that's just
I
one
can
of the
take
ways.
that.
Yes.
Perfect. Okay, then I have another answer that's just come through. Let me just read what's written here. I want to read out. You can't avoid paying tax. However, you can split your income and put your family or kids on the payroll.
Income wages. Yeah, okay, I would take the second one.
You'll take the second one as well. Okay, so Mina, you've got your 2. We will ask them both Mr. Mwale and Rose Choke. If I did send my number on the chat, please WhatsApp me with your details and we will then courier the price to you.
Please do fill in the feedback forms as well. That's also shared on the chat.
Yes, and I will share it once again, Mina. I think I'll just share the form, the link to the form again, so that they can ensure they complete it.
Any more questions for Prof? Or if you feel you want to do this in private, his assistant's number is in the chat.
Mina, I'd just like to say that people generally, when I talk, they don't like asking the question, because when they put the question on the chat box, people say they don't want others to know that they have a SARS investigation or anything like that. And I always find whenever I do these kind of talks, people will privately mail me, or they'll send me a WhatsApp chat asking me the questions on a private basis rather than on a public platform. And that's been my experience.
That's absolutely fine, Prof. We have shared your details on the chat, so people will contact you in the future. Thank you so much. I can see lots of responses on the chat at the moment. So thank you very much, everybody, for joining us this afternoon. We have finished 15 minutes early because the speaker one had very few questions, but we can still stay on for you to discuss anything else that you'd like to for a few minutes. We'll be on for another few more minutes, and then I will close the webinar and say thank you to all the participants, the staff, as well as Prof. Thank you for your time, especially, and to ERA and ENS Africa as well. Thank you very, very much. It's a lovely afternoon. Please do enjoy the rest of the afternoon.
Just from my side, as we're ending, I have once again shared the link for the feedback form. Please note it's important that you complete it so that you can earn your CPD points. Thank you so much for attending. We look forward to receiving all your information.
Thank you, Jared, for your comment. Prof, this is for you. Paperless practice is very efficient and convenient. Globally, we are moving into AI. I agree 100% with Prof.
Yes, that makes perfect sense.
ShiftDev also offers wellness workshops to companies and private institutions. Please do feel free to contact us if you want a private workshop or one that is accredited for 15 CPD points. Thank you very much, guys, and thank you for joining us. It was the first webinar for this year and hope to bring you more. I know it was an afternoon webinar. Usually our webinars are in the evenings between 7 to 8, and the next one would be in the evening. Take care and God bless. I will be ending the meeting now.